Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This is now stay with me on this. This is a little bit, again, esoteric, but when I thought of this analysis and I got some of these ideas from a professor in China who writes a blog and does a fantastic job, and he's very, very honest about what's going on in China, and I found this analysis fascinating and put some of it together ourselves here, John Ross and I, and we layered some of his ideas on here. But this is going back again, looking at the U.S. current account deficit. Okay, as I just have shown you this part here. The U.S. current account improving. This was the weak dollar policy period in which the symbiotic relationship was very much in play. But I want to let you look, and I'll look for that blog address, Ken. I'm sorry, and as soon as I'm done, and I'll type it in. But let's go back and look at Japan. Those of us with some gray hair that were around, back in the early 80s and even 70s investing, we remember Japan. They were basically going to take over the world. They bought Pebble Beach, Rockefeller Center. They were just blowing and going. Their finance minister was out saying that the U.S. is going to be our farm. The Europe is going to be our boutique. They basically had free credit, blowing and going. And a little thing happened in the U.S. called the 1987 stock market crash right here. And what that did, it scared a lot of people and led to a real decline in the U.S. current account deficit at the time, fewer and fewer imports. Japan was the biggest exporter in the world, blowing and going, much of their exports coming into the U.S., their main driver. They were referred to as the credit superpower of the world. And this happened here in 1987, and by 1988, the Bank of Japan already started getting nervous. They saw this improvement, and they saw their exports declining to the U.S. So what did they do? What was their policy structure, even in 1988 when they saw this coming? They said, well, what we're going to do, we're going to boost investment in our stock and property markets. We're going to do a lot of stimulus in there, just like China's doing now, because they believed if they did that, it would give their export-oriented companies a chance to turn inward, all right, and start to look for investment opportunities inside Japan, kind of change their focus to a degree. They also thought this investment in their stock and property markets would trigger the wealth effect to their local consumers. Think of the U.S. wealth effect. One of the reasons that this right here is happening is because U.S. consumers have lost about $15 trillion in wealth because of the collapse in their stock and housing market. Well, Japan was ahead of the game. They saw this potential happening, so they said, it's time to start pumping money into the stock and property market in order to drive some consumer wealth so we can start turning this economy around. Stimulate consumers, stimulate residential investments. Guess what? It didn't matter. This money was taken off the table. Because of this strategy and all this investment very much turned into really bad paper. It was a financial bubble, a huge financial bubble. The Japanese stock market broke in '89. The housing market broke in a big way in '92. And Japan was in the doldrums for years. Fast forward to China. They're doing this. They're not even doing this. They're really not making an effort to have their companies start looking inward for opportunities. You got to also remember in China, the political class is what gets all the juice, and the political class have a lot of stock investments and they have a lot of property investments. So not only is the idea of putting money into the stock and property markets, they're called the princelings. It's what they refer to as the princelings in China, drive a lot of policy and get a lot of the juice. So they've been pretty happy with the run-up again in the property in stock now. But the majority of the people, the majority of the domestic consumers out there don't have a lot of money, and they're not seeing a lot of help in terms of, again, a lot of investment opportunities. They're still not seeing the buffers that we have in the West: unemployment insurance, health insurance, those types of things. So with rising unemployment in China, it's so much more dangerous because they don't have the buffers. So they're going to save even more, which again pressures down on a domestic economy that already is too low relative to the size of China. And the princelings, the politically connected, are pretty happy right here, but there could be a real tidal wave about to crest over them. So we've really seen no stimulation in terms of the consumer. We've seen some residential investment, again, from the wealthy class, politically connected in the cities. These are the type of people that I was talking to. There were a lot of young kids at Beijing during the conference, very polite, very smart, but very arrogant in that they had it all figured out. But I don't think they have it figured out. And this credit crunch right here, let's use that as a parallel to the U.S. stock market crash. And you may also remember, and this was a point that we used to make in our presentations a couple years ago, the economists around the world would always say there's major global imbalances. We need to fix the imbalances in the world. The U.S. current account has to rebalance. Well, the reality is every time we've seen a rebalancing of the U.S. current account, we've had major global conflagrations, where the triggers basically, or triggered jointly, the 87 stock market crash. We saw an improvement, notice right here in 2000, right around where we had the stock market crash and NASDAQ bubble. And of course, we have an improvement right here triggered by the credit crunch. So keep it in mind when the economists talk about these things. They're not really on the ground suffering with real people. It's just theory. So the benefits of removing the caps, and I told this to the Chinese, which they of course had, they really didn't care, was it really creates a pressure valve. A floating rate currency creates a pressure valve for all these internal pressures, so to speak. Money can move out, money can flow in freely. Artificial prices are wiped off the map. Supply and demand, it's a more market-oriented system. So it also, if they allowed and again, not as big a concern now with the fall we've seen in commodity prices, but at the time there was inflation. If they allow their currency to appreciate, it blunts all their import costs, meaning if their currency appreciates, the cost of raw materials, which is huge to China, would fall dramatically. And again, that would be a very big benefit to them. It would also reduce their domestic money supply. If they allow their currency to appreciate, they don't have to buy all the U.S. Treasury bills. They don't have to go in and mop all this stuff up. They don't have to create all this false liquidity in the system and do all these things what they do in order to peg the currency. It also allows their local domestic market to grow in a very, very big way. If you're a consumer in Japan and your money goes up in value, all of a sudden your wealth has gone up in value. It also provides some global liquidity in the world of deleveraging. As I said, Roach Motel, money goes in China, can't get out. If they took the cap controls off, money could flow in freely in and out, and they'd be a more normalized economy, and I think it would be to their benefit and reduce those pressures and those bubbles that are building because of the excess stimulus that we're seeing from the government. Local producers would lose externally. They would lose some of their market because, again, of the increase in the currency, but they would gain a lot of internal opportunities we think that would make up for it because, as I said, if they take off some capital controls and really loosen up the domestic side, it opens up internal opportunities for Chinese companies, which have a leg up already to the international companies. They know their own domestic market better. So that was kind of our policy pronouncement, so to speak.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.